Okay guys, so a warm welcome to today's video. I'm going to be showing you in this video, if you are trading gold, how you need to understand what's happening in the bond market, because that's the key driver for when investors are buying or selling gold in the markets. Investors always need to make sure that their money is being protected from inflation. And if they can't buy government bonds and the real rate, which is just the amount of interest paid on a government bond, is not protecting an investor from inflation, that's when they buy gold. And if the markets are able to buy government bonds to protect them from inflation, I will show you throughout history that gold's price always drops in value. As soon as you understand this, you will know exactly how to trade the commodity, because you'll be knowing what to look out for. Okay guys, if you enjoyed this video, please like, comment, subscribe, and let me know if this has helped you in your trading journey. Thank you. Okay guys, so welcome to this video where I'm really going to break down and educate you on how to trade gold and why professional investors are only ever buying and selling this commodity as a hedge against inflation when they can't borrow money to the US government and buy government bonds to protect them from inflation. So just remember, if you're an investor, let's say you're a pension fund, you're an insurance company, you're a hedge fund, and you don't want to be betting all your money in the stock markets because you could lose a lot of money if your investment goes wrong. You don't want to be investing in the crypto markets or the forex markets and even the commodity markets on assets like oil, for an example, or copper. So gold has always traditionally been a safe investment for investors if they cannot borrow money to the government and get a real return on their money. So when I say real return, if you borrow money to a government, you're guaranteed to get your money back plus some interest. And investors are always paying attention to, is that interest I'm getting paid from the government covering my money from inflation? Is it protecting me from inflation? And if it is, then you're going to see gold's price always decline going back through history. And when it's not protecting investors from inflation, you'll see gold's price go up over time throughout history. So I'm going to show you this in more detail so you can get a really, really good understanding for how we can assess what is happening with the price of gold and real interest rates. So in this Excel spreadsheet, we have the 10-year government bond. So this is the interest rate paid on a 10-year government bond, and the interest rate is known as the yield, okay? So we have the data go back from September 2000 all the way to present day 2022. We have the interest rate paid on a 10-year government bond. And then in column C, we have the monthly inflation data going back all the way to September the year 2000. And what we're doing is we're taking that interest rate paid on a 10-year government bond and we're minusing the rate of inflation to tell you how much interest an investor is receiving from the government over the rate of inflation. So is that interest rate protecting their money? Is their money growing? So in September 2000, the money is growing. You're making 3% on the dollars that you've invested in a 10-year government bond when you're adjusting it for the rate of inflation because of the interest rate being paid on that bond. So that's a positive return for an investor, okay? And then we have the price of gold. So on this chart, we have on the left-hand axis, you can see the price of gold. On the right-hand axis, we're looking at the real return on a government bond adjusted for inflation. So anything above zero is telling you an investor is making money if they borrow money to the government, even over the rate of inflation. And then anything below zero is telling you that the dollars they're getting paid back in interest from the government is losing its value to the rate of inflation. So you see gold highlighted in yellow, and then you have the real interest rate. So the interest rate being paid to an investor over the rate of inflation, it's called the real rate. And what we're looking at is the historical performance of what happens to gold when investors can no longer buy government bonds to protect their money from inflation. So look, in the year 2000, an investor was receiving 3% interest over the rate of inflation. You can see here in the year 2000, they was receiving around 3% interest. Over the next 12 years, we can see the interest rate goes from 3% being paid, and we can look and we can see over this next 12-year period, it goes all the way down to paying a negative, basically minus 1%. So if I'm borrowing money to the government in the year by around March 2012, the dollars that I'm borrowing to the government is no longer protected from the interest I'm receiving, okay? And when I say being protected from the interest rate I'm receiving, I'm saying because inflation is higher than the interest rate. So the rate of return for an investor is turned negative. Okay, so we can go down here, we can see by March 2012, the interest rate is now minus 0.74%. Look what happens to the price of gold as this interest rate turns more negative and negative over this whole 12-year period. The price of gold goes from $250 an ounce all the way to $1,750 an ounce. So why are investors buying gold over this whole entire period of time? Well, think about it, guys. The rate of inflation continues to rise, but the interest rate is not protecting them from that inflation. So investors can no longer look at government bonds as a safe place to park your money because you're not being protected from inflation. So they take their money and they put it in the gold market because gold's price goes up astronomically over that period of time. So if you're investing in gold, let's say, so let's get this chart back up over here. So let's say over that period of time into 2012, let's say your gold has gone up in value during that period by, let's say, well, the data only goes back to 2007, but let's say it goes up by a really healthy 180%, 250%. You are more than protected from inflation. Okay, if inflation is running at 2%, doesn't matter. You made 250% return on your money. So this is how, guys, investors are buying gold, because this advance in the gold's price is protecting that money from inflation. You've made more than enough returns to cover you from inflation. Okay, you made 248% when inflation is running at 2%. You're laughing. You made a lot of money. Okay, and then look what happens. So let's now look what happens. Why does gold's price from 2011 start to drop all the way into 2016? Because the interest rate on the government bond yield starts to then turn positive. So if you look at the interest rate from March 2012 all the way until around September 2017, it remains around 1%. So you can see, look, from 2012 it goes up to 1%, and you have declines, but it remains around 1% until around 2017. And gold's price over this whole entire time period, even though it fluctuates, it literally remains the same. It's paying you, as you can clearly see here, from around September 2013 all the way until March 2018, it remains at $1,250 an ounce, because the interest rate on a 10-year government bond goes up and it's paying you around a 1% positive interest rate over inflation. So investors go back into the bond market, they're buying bonds again, and you can clearly see that investors are happy to put their money in bonds, and that's why gold's price does not go anywhere. Okay, and then what happens? Something happens again in the economy, which I'm going to break down in a second, where the interest rates get cut and then inflation starts to rise. And look what happens as the interest rate starts to plummet again, no longer protecting investors from inflation. The interest rate goes so negative, investors are losing 4% of their dollars invested to inflation at some point by 2021, and gold's price again takes off. And when does gold's price take off? When that 1% interest being paid to an investor starts to decline. Look what happens at the exact same time. Gold's price starts to rise again. Okay, and since 2022, as interest rates have been going up, we've seen the interest rate, the real rate of interest being paid, starting to increase again, because central banks are raising interest rates right now. And it's no surprise that gold's price is now starting to decline. As we know, in the market, we've seen gold's price starting to drop throughout 2022. We've seen a decline in gold's price. Okay, so what we can see is this. So what I'm going to show you here is, you see how for an example, we can see here in December 2021, and you're going to now understand why does a 10-year government bond yield go up and down? Why does the interest rate fluctuate? Well, it's all down to inflation. So look, in December 2021, the 10-year government bond yield is paying 1.41% interest to the investor. Where was inflation in December 2021? Let's have a look and I can show you. In December 2021, inflation, you see here, is 4.9%. You see that? So inflation's at 4.9% in December 2021. The Fed hadn't started raising rates until when? March 2022. So because the Fed hadn't started raising rates, investors didn't want to be buying bonds. They're not in the bond market, okay? Interest rates are low and negative. Here, if you go back to this chart, in April 2018, the interest rate on a 10-year government bond is paying you 2.96%. Let's go back to March 2018. Inflation is stable around the central bank's 2% target, as you can clearly see. And look, the interest rate is higher because at that time, interest rates were high and controlling inflation. So investors were getting a positive return on their money. At this period of time, interest rates were low at 1.51%. But look what happened with, so the interest rate on 10-year government bond was 1.51%. But look, the interest rate on inflation was extremely high at that time. So the interest rate was negative. So what I'm trying to show you is the 10-year government yield, the interest rate being paid on government bonds, is always going to fluctuate relative to where interest rates are and to where inflation is. And that's why I'm showing you now that in history, you always see as the interest rate paid on government bonds goes from 3% all the way down to a negative 1%, you see a decline in the value of you see a decline in the 10-year government bond yield, and you see a big shoot up in the price of gold, because that's when investors are using gold as a protection from inflation because they can't buy government bonds. The moment the government bond yield starts to rise again and turn positive, and it goes from paying a negative -1%, as you can clearly see here, up to a positive 1%, gold's price starts to decline. And as that interest rate stays at 1% over the next, from 2013 all the way to 2018, so we're looking at a 5-year period, gold's price remains low for 5 years because investors don't need to buy gold because they can just keep their money in the bond market. And as soon as they can't keep the money in the bond market and interest rates adjusted for inflation start to turn negative, as you can clearly see here, that's when gold's price starts to rise. And why was the interest rate turning negative? I'll show you right now when we have a look over here. So if we go and look at the federal funds rate, which is the central bank's interest rate, so federal funds rate, and let's go to investing.com because you can get the monthly data here. So this is what I'm going to show you guys. Now you're going to have a good idea as to why gold's price took off in 2018 when interest rates were being cut in the United States. Okay, so look, if we go to 2018, and I'll show you the data in more detail. So let's go lower, 2018. Well, it was actually 2019. Sorry, not 2018. Gold's price started to take off in 2019, as we can clearly see around here. Look, 2019 is when gold's price started to rise. And why was it rising in 2019? Because interest rates by the US Central Bank were starting to be cut from September 2019. So interest rates start to get cut. That causes inflation. Look, it goes from 2% all the way down to 0.25%. And in that period of time, obviously inflation is starting to rise. So you're getting big rate cuts from the central bank. Inflation starts to rise. Investors automatically know that the 10-year government bond is no longer going to protect them from inflation. That's why gold's price takes off. You see? So that explains it. So before the rate cuts happened, rates were nice and high and steady, okay? You can see the 10-year government bond was paying 1% interest all the way until 2019. And as soon as those rates got cut, inflation was rising, but the interest rate was no longer protecting investors. That's when gold's price took off. The same way as the 10-year yield here was declining over that whole time period of time, that's why gold's price takes off. And whenever the yield rises, that's when gold's price goes lower. So now you know as an investor when to buy gold, when to invest in the commodity. You always have to be looking at where is inflation, what is happening with the 10-year government yield, the real interest rate on 10-year government bonds. Is it positive or negative? If it starts to turn negative, gold goes up in value. If it starts to turn positive, gold goes down in value. So when we're trending in the markets right now in a bearish trend, as we can clearly see with gold, as rates are getting jacked up right now in the United States to deal with this high inflation, As long as that real rate starts to turn more positive and more positive and more positive, then we should expect to see gold's price decline. Okay, guys, and you can see in 2022, when we have a really good snapshot of the United States, the real rate, so look, this is the 10-year government bond minus core inflation. It's gone from minus 3.73% down to minus 3.07. So it's improved. That is why you're seeing gold price decline. So guys, I really hope you enjoy that. If you want to come and get more information on trading, you can come and join this free Telegram channel, which I have a lot of video updates, 741 members, explaining a lot of details about markets, how to invest, how to profit from different markets, so currencies, commodities, crypto, forex. And then of course, if you're interested, we do have a multi-course package where you can learn about investing in forex, stocks, crypto, and commodities. All right, guys, so if you enjoyed this video, please like, comment, and subscribe, and hopefully I'll be training with you soon. Thank you.